Hi, I'm Gail Guerin, and we're here at the SuperInvestor Asia in Singapore, and I'm with Saki Georgiadis. And Saki is head of Asia for Hermes. And first off, can you give us a little bit of background on what Hermes is and why they recently, a year and a half ago, opened up an investment office in Asia?
Sure. So Hermes is a multi-pension fund platform, effectively. So it's a shared platform for institutional investors to have the opportunity to really gain access to private markets globally. And private markets for us means private equity. We've got the majority of our heritage and investment experience in private equity, but also private infrastructure and private debt, which is an emerging asset class for us. It is a group that has been sponsored for over a decade now by British Telecom Pension Scheme, which is the largest pension scheme in the UK. They continue to be a major shareholder and backer of our business, but we've got a number of other institutional investors that we look after around the world, including the Royal Bank of Scotland in the UK, amongst others. The business, or the solution rather, that we offer to our clients is a customized solution. It's a separate account solution. So in excess of 95% of our capital is in the form of separate bespoke accounts.
Right, as compared to a fund of funds, which you're not.
As compared to a pooled vehicle or a fund of funds, right, or whatever we want to call it. So yes, we are an aggregator of capital, and we're not only investing in-house money, if you like some of the big Canadian pension funds would, for example, but equally we don't aggregate small equity checks from small retail or high net worth investors or mid to low size pension funds. The one thing to say to finish off with the introduction is the biggest customization point in our offering is co-invest, and the reason for that is we believe that in this investment environment where returns are being compressed globally in private equity and all asset classes, to be frank, fee mitigation is crucial. And we've been co-investing now for 12 years. We've gradually brought up our clients from 0% allocation to co-investments to now 50% for all our separate account clients, and we find that is a key way. It's a key way for them to effectively halve their fees if we look at it simplistically.
Right. So you've been investing now in Asia for a year and a half, is that, or longer? I know the office was established a year and a half ago.
That's right. So we've been investing in Asia for over 10 years. We've been approaching Asia more thoughtfully, and by that I mean with a co-investment strategy for the past 8 years, and we've completed approaching 20 deals now in Asia on the co-investment front. We did 3 last year, 4 since Hermes GP was put together in 2010 from the merger of Hermes and Gartmore. And a year and a half ago we decided, well, a bit less than a year and a half ago, we decided to establish an office on the ground. And this was really driven by 2 things. Firstly, we are adamant believers in the secular story of Asia. There is a long-term catch-up trend. We've seen that trend play out globally in other emerging markets that were even less kind of compelling growth stories like Asia. So I think there's fundamental kind of economic underpinning to the logic that these markets are going to be catching up to US and Europe in terms of GDP per capita, and that will eventually make Asia one of the most important private equity markets globally. It's already important, but it can't be compared in terms of depth and breadth to a market like the US, where private equity has been taking place for almost 30 years now. So that was reason number 1. We believe in the Asia story. Reason number 2 is to execute our investment strategy, which is co-investment led, and to service our clients the way we want to service them. It is very difficult to execute that remotely. This is a big region, it's a complex region, there's time zone challenges, and if you want to co-invest, you need to be reactive. You need to be able to be on the ground. Effectively, so you need to be on the ground, and people will make the argument, and I think we still struggle with that, from time to time, that you need to be on the ground in multiple locations. China is Beijing, for example, is over 6 hours flight from where we are at the moment. And in a European context, that's a long-haul flight. I mean, you get beyond Russia and beyond Moscow from London in 6 hours. In fact, it's just 4.5 hours to get to Moscow. So it is a challenging region. And if you want to have reaction times on the co-invest that are 3 weeks, 4 weeks, that kind of time frame, you got to be here, and you got to be able to show to the GP that you understand the markets. Even on the fund side, we find the fund investing environment increasingly challenging, and we'll come back to why that is. But as we have tried to kind of develop our fund exposure into more sophisticated positions, so more interesting pockets of opportunity than the very obvious pockets of opportunity that someone would naturally see from London or from Boston, we felt again that for that activity we'd be better off being on the ground.
So as we talked about, Asia is a huge place. So where are you focusing your efforts? Because you can't be investing in every country.
Sure. We try to cover every market. Fundamentally, we believe that there's interesting deals to be done in every market, but we have a limited amount of capital. We don't have I think it's more a problem than a privilege of having to put billions to work every year. So we put in Asia between 150 and 200 million dollars a year. That's between funds and co-investments. And we believe for that amount of capital, you can find interesting pockets in every geography. Having said that, we do have a framework for analyzing different private equity markets, and I can give you the highlights of that, and from there kind of tell you where we're focusing at the moment.
So is the framework different in Asia than it would be for Europe or the US? Are you different parameters?
No, we've got one framework, but the nuances around how you evaluate markets are very different. We think of 4 factors when we look at a private equity market. We think of growth, and as private equity investors, we're interested in long-term secular growth rather than cycle, although you have to be cognizant of the cycle as well. So growth, capital market sophistication, ecosystem. So do you have debt capital markets? Do you have IPO markets, equity capital markets? Do you have a GP kind of value chain around you that you can buy from, exit to? Is there a talent pool, in that industry that is of sufficient depth? And the other 2 factors are culture and governance, and these are more difficult to assess. People typically overlook them when they look at private equity markets, and I think Japan is a very good example where private equity had a lot of the other ingredients, but culture was not conducive to private equity. The attitude to change was not conducive to private equity, and there were a lot of investors in 2006, 2007 who were very excited about the prospect of Japan becoming a big Asia buyout market.
Right.
And I think we've all learned, us included, that culture doesn't change overnight. So it has remained an interesting but niche opportunity, Japan. So that's just to give you an example. Now, if you have these 4 ingredients, you have the ingredients that you need to have a good private equity market. There's a few others, but these are the key ones. But then the big question is how much capital is trying to address this opportunity set. So if you have a great private equity market, let's say we have the US private equity market, and you've got checks on all 4, but the amount of capital that's being raised is so huge that GPs are not able to put it to work quickly, that dry powder builds up, that people start bidding assets up and competing with each other and going very aggressive on the leverage to get the price right, and so on. Then you're not going to see good deals, you're not going to see good returns. It's a pricing issue. So the level of funding in a private equity market defines the framework for valuations at the deal level. So these are the 4 factors, and then how we think of demand supply. Now, if you apply this to Asia, to answer your question, which was where are we focusing on, we still think China is an interesting market,
and it's seeing a lot of capital. So that
despite
in
the
and
fact
of
that
itself
it's
is
seeing,
a challenge.
yeah. So let me address this, because I think it's important, and I'll contrast it with India, because people think of China and India as the 2 largest private equity markets. China has attracted a lot of capital, and I would say in certain segments of Chinese private equity, way too much capital. The thing that is good, though, about Chinese private equity is that the culture is very conducive to private equity. People are, entrepreneurs are results-oriented rather than, let's say, perception-oriented. There is no concept of the family-owned business and a certain amount of pride in nurturing and perpetuating and conglomeratizing, to make up a word, family-owned businesses.
Right.
And that makes entrepreneurs more open to selling stakes. Equally, if you compare the two talent pools, the entrepreneurs in China and India, you will find, and it's not great to generalize, but you will more often find entrepreneurs in India that have an intense focus on cost of capital, and therefore the balance sheet side of their business, and therefore will be more prone to optimizing, their capital structure, meaning they lever more, they're more willing to lever. And you will find more entrepreneurs in China who are P&L focused. So what this means is that the entrepreneurs in China are typically more willing to take private equity capital. They're less sensitive to the cost of capital, which makes private equity able to operate in China. So this is at the fundamental level, and I just touched on cultural aspects, but we could talk about the rest. But the two opportunities are being addressed by a lot of capital, both markets. I would argue, and we feel as a firm, that India is more, there's more excess capital in India than there is in China.
Really?
In terms of private equity. Absolutely. We feel China is a deeper market in terms of the number of corporates that are seeking private equity capital. We also see that it is a less intermediated market, and therefore Chinese entrepreneurs are more prone to doing deals on the basis of relationship rather than on the basis of, okay, let's hire an investment banker and run a process, right? So that to us is clearly translated, although both markets, you rightly say, have a lot of capital chasing the deals, in higher valuations in our co-investment pipeline and deal flow on the China side.
Right, you're seeing more opportunity in China. And it's earlier too, because there's been money in India a lot longer on the private equity side.
Absolutely.
So.
Absolutely. So beyond that, we think Southeast Asia is interesting. We think Korea is interesting. Japan is a niche opportunity, as I said, but there's value plays. We would like to get there. I don't think the market is ready for that.
But you'll strive for that.
There's a lot. We won't strive. We will be open to achieving it when the market's ready. So what we've done is we've said we'll do deals as small as 5 million on the co-invest side in Asia, although our sweet spot is, let's say, 25, 30. And the reason why we've chosen to do that is we value the opportunity to continue to build our track record here, regardless of the quantum of capital that gets put to work. And we've taken a long-term bet that the market will move, towards where the US is, where the European market is. It'll be very different. This is Asia, but we will be doing more co-invest in 5-7 years' time than we're doing now.
And I bet you'll have offices beyond Singapore.
I hope so. I hope so.
Okay. Thank you very much.
Thank you.